Welcome back, traders. Good morning. My name is Neville Hornsey, market analyst with YouTrading, and today I'll be talking about the US dollar. All right, as always, we're going to start with the YouTrading.com Forex heat map. And as you can see here, across the sort of US dollar spread, we've got all green. So the dollar is the strongest. And if we look lower, the sort of Aussie is appearing to be the weakest. The actual composition, if you like, is the bottom left-hand corner is red, top right-hand corner is green. So it's more of a risk-off day today. Normally, when we see the bottom left-hand corner, when the commodity pairs are all green, that's when the markets, like the equities, move higher. If we go to an economic calendar, today we've had some sentiment sort of news from Germany already before the London Open. We're about to receive some EU money M3 annual growth, and later on today the euro is going to be affected by the ECB minutes that comes out at 12:30 British summertime. Then an hour later we received the US initial jobless claims and some sort of core PCE GDP data from the US. So this jobless claims numbers are probably going to be more market moving than everything else today in terms of volatility. But it is the start of the Jackson Hole Symposium, so a lot of trades may be sort of subdued because they'll be waiting for news to come out of that event. Tomorrow we have Fed Chair Powell actually talking, and he'll give us some sort of summary of what they've been talking about, but also the market's waiting to hear whether or not the Fed's going to be tapering their asset purchases. Now, tapering means that they're looking to reduce purchases of mortgage-backed securities or treasuries, and that is essentially tapering of quantitative easing. And quantitative easing, or QE, because it's easier to say, was based on removing collateral out of the markets, putting back in some sort of reserve assets into the banks, and this was to lower the treasury yields. And the reason for doing that is that treasury yields are like the benchmark for other interest rates, such as corporate bonds and mortgages. So if you can reduce the interest rates, then people are more likely to go out and buy a large ticket item like a house or car, which increases spending, which gets the economy going. So if you then look to what that could mean for the US dollar, here we have the Fed database, and big black line is the trade weighted US dollar index. So basically sort of like similar to the Dixie. And then the solid brown line, if you like, is the 10-year break-even inflation rate, because even if we've got a positive interest rate or Fed fund rate, if you bring in inflation into this, then we've been having negative yields recently. And then the dashed lines are basically the sort of across the curve from the 2-year Treasury constant maturity rate out to the 30-year. Now, the Fed did move from buying sort of short term into more longer term. And you can see here as the demand for those sort of longer term bonds sort of risen, then the yields were dropping. As this 10-year break-even inflation rate rises or accelerates higher, that's when we sort of see a deceleration or a drop in the US dollar. And you can see here that that particular relationship has been that the 10-year break-even inflation rate has been accelerating to the downside, and we've been basically seeing the US dollar rising. But over the last year, the US dollar's kind of gone sideways, so we really need to see some sort of move in these rates. And that could happen because of what happens in this FOMC, in this Fed symposium this week. The minutes from June from the FOMC showed that various participants offered their views on the committee's agency MBS purchases to mortgage-backed security purchases. Several participants saw benefits to reducing the pace of these purchases more quickly or earlier than the Treasury purchases in light of valuation pressures in the housing market. So as the coronavirus came in, people moved out of the urban areas into the suburban and rural areas. There was more demand, less supply, house prices went up. And as we've said, the interest rates have been so low for so long that people were able to afford more expensive houses on their debt. The debt was cheaper to buy. And now we're sort of seeing, the coronavirus is being tapered, if you like, by the vaccines. We didn't have that in 2020. Now we have that across the world. There's more vaccines, and it doesn't look like coronavirus is going away, but we're in a different place fundamentally. So if the Jackson Hole Symposium this week, tomorrow, when Fed Chair Powell gives us his speech, says that they're going to not only reduce MBS, but they're also going to reduce the sort of asset purchases in the future of these longer term bonds, then we should see a reduction in the demand for bonds, and then they will drop in price, which will mean that the yields will go higher, which would then probably mean that the US dollar will go lower. So we go back to the active trader platform. We've got here this red upper sort of level and lower level, and that is the start of August trading. And you can see here at the start of August, we had this big impulsive move higher, broke out of the sort of opening week range. And then what I've done here is I've got these cyan lines, so the low to the high and then to the middle. You can see as we came back down in this sort of corrective move, we found support at the 50% sort of retracement of this opening range and like into the 11th of August high. From then on, we broke higher again. And this week, we had an impulsive move to the downside, following on from sort of Friday's close. And then we've been stuck between the low of Monday, which is here at 92.90, and the high of the opening range in August. So if this does become a problematic area and we can't get any higher, then we'll be looking to come back down, test the 92.50. And obviously, if there's some reason why the US dollar was to collapse, then we'll be targeting this double bottom back down at 91.80. Looking at the euro versus the US dollar, this morning, London opens. We had obviously had some data out of Germany. The market sold off, but only into this sort of old resistance, now support. And the London Open seeing the euro rising, and it looks like it's going to be really trading into these two green candles here, which I had down as a sort of supply zone. Get above there, there'll be some stops there, and then we can accelerate higher. So if I go to say daily, if we start getting above this big impulsive red candle, then we'll be looking to target up to maybe 1.18. And then there's not a lot really in sort of market price action until we get back up to the sort of 1.1850, this zone here. So across here. So if we get above that high today, then we're kind of opening up to some decent higher prices. Okay, so looking at the dollar index on a daily, we swept the highs of March. We could be breaking down this sort of trend line. If I just draw this trend line in here, and then go down to the hours, so you can see it a bit easier. So you can see that this trend line rising up from the 4th of August underneath the 16th. Draw a bit more accurately. The trend has been broken, retested, and we could continue down that. So for me, I'm looking to see if the dollar can get back into this weekly opening range, get back below 92.50, take out the stops here, and then come and sort of attack, if you like, these double bottoms down at 91.80. I hope that was interesting and useful, and I'll speak to you tomorrow.